The U.S. federal income tax system uses a progressive bracket structure that determines the rate at which your taxable income is taxed. Each year, the Internal Revenue Service (IRS) adjusts these tax brackets for inflation and enacts policy changes through legislation. Understanding how the 2025 tax brackets work is critical for effective tax planning, optimizing withholding, estimating your tax liability, and making strategic decisions about income timing, deductions, and credits. Below are the top 10 key points you need to know about tax brackets for the 2025 tax year. 1. Progressive structure remains in place. The U.S. tax code continues its 7-tier progressive rate system in 2025, meaning income is divided into slices, each taxed at a different rate from 10% up to 37%. As your taxable income rises, only the portion within a higher bracket is taxed at that higher rate, not your entire income. This structure is designed to achieve greater tax fairness by increasing marginal rates for higher incomes while keeping lower rates for entry-level earners. 2. Inflation adjustments increased bracket thresholds. For 2025, the IRS raised each bracket's income thresholds to reflect inflation, helping prevent bracket creep, where inflation-driven wage increases push taxpayers into higher rates even though real purchasing power hasn't improved. For example, the 22% bracket now starts at $47,625 for single filers, up from $44,725 in 2024, while the 24% bracket begins at $102,800, ensuring more income stays taxed at lower rates. 3. Standard deduction also rose for 2025. The standard deduction, the portion of income exempt from taxation, was increased for 2025 to $14,600 for single filers and $29,200 for married couples filing jointly. A higher standard deduction reduces taxable income, keeping more taxpayers in lower brackets. Many taxpayers will find it simpler and more advantageous to claim this increased standard deduction rather than itemize. 4. Income phase-outs and bracket interplay. Various credits and deductions phase out at certain income levels that interact with bracket thresholds. For instance, the child tax credit begins to phase out for joint filers above $400,000. Because your effective marginal tax rate can spike when a credit phases out, knowing both bracket thresholds and phase-out ranges helps you plan income recognition or deferral to avoid unexpected jumps in tax liability. 5. Long-term capital gains still favor lower rates. Long-term capital gains and qualified dividends continue to enjoy preferential rates, 0%, 15%, or 20%, depending on your taxable income. For 2025, the 15% rate applies to single filers with taxable income between $45,650 and $517,200, offering a meaningful tax advantage over ordinary income rates. Properly timing the sale of investments can help you stay within a lower capital gains bracket. 6. Surtax on net investment income persists. High-income taxpayers remain subject to the 3.8% net investment income tax, NIIT, on the lesser of net investment income or the amount by which modified adjusted gross income, MAGI, exceeds $200,000 for single filers, $250,000 for married filing jointly. When combined with top ordinary or capital gains rates, this surtax can push your effective rate on investment income above the standard brackets, emphasizing the need to consider surtaxes in planning. 7. Alternative minimum tax, AMT, interaction. Although AMT thresholds were also inflation adjusted, high earners must still be aware of how parallel AMT calculations can override bracket benefits. For 2025, the AMT exemption amount increased to $82,100 for single filers, $127,550 for married filing jointly. If your itemized deductions are high or you have significant preferential rate income, you may inadvertently trigger AMT, so monitoring both regular and AMT computations is essential. 8. Qualified business income deductions impact. Pass-through business owners can still claim the 20% qualified business income (QBI) deduction under Section 199A, but the benefit phases out at higher incomes. In 2025, Phase-in thresholds begin at $191,950 for single filers and $383,900 for joint filers. Since this deduction effectively reduces taxable income, understanding where your business income falls relative to these thresholds can influence your overall bracket position. 9. Withholding and estimated tax updates. Each year, the IRS updates the withholding tables employers use to calculate payroll tax withholding. For 2025, those tables reflect the new bracket thresholds and standard deduction amounts. If you have multiple income streams, side gigs, or significant investment income, you may need to adjust your W-4 withholding or make quarterly estimated tax payments to ensure you're not under-withheld and subject to penalties. 10. Strategic income timing and deferrals. With the brackets and deductions front of mind, you can employ timing strategies to optimize tax outcomes. Deferring bonus income into January 2026 or accelerating deductible expenses into 2025 can shift income across bracket boundaries. Similarly, contributing to tax-deferred retirement accounts, health savings accounts, HSAs, or flexible spending accounts can lower taxable income, keeping more of your earnings taxed at lower bracket rates. Understanding the nuances of the 2025 tax brackets is crucial to effective tax planning and minimizing liability. Key considerations include the progressive rate structure, inflation-adjusted thresholds, interplay with deductions and surtaxes, and the impact of various phase-outs and preferential rates. By staying informed about standard deduction increases, capital gains brackets, QBI deductions, and withholding updates, you can make strategic decisions, such as timing income and maximizing deductions, that keep more of your hard-earned money in your pocket. Review your situation regularly or consult a tax professional to tailor these insights to your unique financial circumstances.